Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
So given we just sent out the most recent quarterly letter, we thought this would be another great time to sit down and go through this quarter's sort of key themes. One of the things we've been talking about really the last year is how quickly interest rates have risen, but also now sort of the absolute level of interest rates is really changing the investment landscape. And one of the themes that you highlighted in the letter was really sort of the evolving nature of investor expectations in light of this sort of current higher interest rate environment. So maybe to start off, why don't we sort of go into that topic as it relates to investor expectations with this higher rate environment?
Yeah, I think I'd also throw out too that Bryden and Eric have done some great work on charts, and we if we're not trying to throw a generic chart into the quarterly letter, but things that we think are really interesting and really stand out, and hopefully the idea is that a way of explaining what's going on and do it in a different way that maybe most people haven't seen. And so this is really the feed. Now back to your main point, which is how much has changed. It's highlighting how much interest rates have changed, and it's a year and a half. It was March of 2022
last year.
March of 2022. It was September of 2021 where we first started showing, it looks like it's going to be inflationary environment. Mm-hmm. And now it's what's extraordinary is that's 2 years. And so we started September of 2021 saying, it looks like it's going to be inflationary, watch out, let's get defensive. Mm. The interest rates didn't actually hit because the portfolio was relatively up and then went flat until March of 2022. And the extraordinary point too, where we're from right now, is that was really a high watermark in the stock market, in the portfolio, and we would say it's almost we've sort of been drifting since then. And really, what we're trying to do is there's lots of income coming in the portfolio. We've been defensively positioned, and we're building our strategy into this world. And this is what you're framing now is just how different the environment is. And one of the main questions we get is where's my consistent rate of return? And how we're trying to explain this is we think we can still compound. Here are our businesses. They're in great shape. We can get our 6, 7, 8% compounding over time as the world is being reset. The hardest problem for being a stock market investor is you don't know when it's going to come. And when we look back to another period of time that had high inflation, high government intervention, and we just picked a chart from 65 to 75, and we might be able to compound, pick that number 7% over the next decade, but you might be up 20 1 year, down 30, up 40, and we could get this wildly volatile market. And still the conclusion is you can't be out of the market. We still have to be in it. We have to be invested to get that rate of return, but it could be wild swings. And we've had, and the final point here, and I'll throw it back to you, but it's when we went back through the last 15 years, post-2008, there's really only been down 2 significant years in 15 years. Mm-hmm. So the average investor experience is really out of sync with the way the world we think it is right now.
Yeah, no, I think that the interest rate environment was, frankly, I don't know anyone that was expecting interest rates to go this high. We certainly weren't. We thought they would go high. It's also, we don't sit around trying to predict what interest rates are going to do. But I would say that rather than saying, rates are going to go higher or go lower, we're just taking the current level of interest rates as accepted fact. And I think what's interesting is just how, we were in this 10, 12 year period after 2009, and all of that changed, or when interest rates went to zero and stayed low, everything changed. Now we're at the highest level since even the early 2000s, but a lot of businesses, a lot of financing of companies, people financing real estate, people using lines of credit in their own life, like all that was predicated on really low interest rates. And so I think what you're starting to see is sort of an acceptance that interest rates are going to be higher, but the change in behavior, both at an individual person, consumer level, but also companies, is so slow to change. But if you're accepting that interest rates are going to stay high, which is, I wouldn't argue with that. Now that's sort of the accepted position. everything is going to change within the equity market. So you're seeing things, where we're trying to, or where we have found value is sort of stable, consistent businesses that are actually active on their stock buyback, companies that hadn't borrowed a lot of money. And so they're not really exposed to rising interest rates, but they can purchase their shares back. And that's been a great support for the market. Whereas other sectors of the stock market that needed to sell equity or needed to finance regularly, you've seen that now sort of, really start to impact their ability to run their business and growth expectations and all of that. So I think it's not just been the rise in interest rates and sort of the now relative attractiveness of bonds, but it's also that companies are not used to this environment. And the longer it persists, I think the bigger risks that are created, but the longer it persists, you will get that change in behavior eventually, because ultimately interest rates are sort of the gravity on all asset prices. But it's been, to your point on the timeline, it's been long enough now where this is all starting to become reality very quickly.
I want to make sure we hit the point exactly what we're doing. So I'll frame the portfolio and then I'll throw it back to you for exactly what defensive means. But I think it's also really pointing out that the portfolio has two sides to it. There's a very hard, tangible asset side, and if people, most historically think of what's real estate and infrastructure, and where these companies have come from. Our best ideas that are doing well this year is in the consumer and industrial side. And so for the portfolio to be roughly flat means that actually half the portfolio is up and half the portfolio is down. And so on the interest rate side, interest rate sensitive, where we are underweight, but those stocks have still not done well. And we're trying to wait, be patient, and rebuild, be able to add into that part of the stock portfolio, and at the same time let the other part of the businesses run. But I just want to, get your comment exactly on what defensive means, how we built a cash position, and what we're thinking right now.
Yeah. So on the cash position in the portfolio, I think the conclusion that we've come away from, and it wasn't a core theme in this quarter's letter, but perhaps, it's been in previous letters and maybe again, at the end of the year. But right now we're running with sort of high teens percentage in cash, which is invested in a T-bill or T-bills. But I think
what is our T-bill rate right now?
Which is over 5%. So, which is, it's almost taken a year for that to sink in, that you can be in a cash-like investment, a short-term government bond, and be paid 5%. Which is it's really almost taken a year for that to sink in, of like, wow, that becomes the hurdle for, almost opportunity costs for making an investment decision. Now, for 10 years, interest rates at the very short term were basically zero. So you almost had no opportunity cost other than, was a business fairly priced and was it going up reasonably well or whatnot. But there's now a much higher opportunity cost where we can be patient on our cash position while we're earning an income in the portfolio, but then, the uncertainty of the path forward hasn't changed. It's almost gotten even more, I would say the path towards a recession has become much more clear. The timing is always uncertain, but the fact that we haven't got there yet doesn't change the fact that that's somewhere on our destination path. So to be earning a high rate of return like that in, very low risk cash position is very attractive. And then the other thing too, we talked about, this is from our investment meeting a week ago, you can go even a little bit further and say, well, what about a 1 or 2 or 3 year corporate bonds? You could be yielding 6.5% in what are very high quality, defensive businesses. And so that a year ago, when the equity market, had kind of meandered down through 2022, the US market had a tough year, Canada bounced around, but was helped by energy and some of the more cyclical parts. But, we were to rewind a year ago, there were so many really attractive equities that we were looking at where we were very excited about at the time. Fast forward a year, I think the opportunity set on finding new ideas on the equity side has become much smaller. And so the fact that we can be earning this return in what is a very defensive positioning, I think feels certainly like it's in our favor to be doing that right now. And so how long that will continue or how long will our position maintain like that, I'm not sure. None of us really know, but we can at least use that as a barometer to the attractiveness of new ideas, because we now have a pretty high hurdle rate for any new investments that we want to make.
Right. Maybe I'll get you just to touch on some of those, just sort of think we're still positive. It's not trying to say you're defensive, sitting on your hands. And our quick comment on real estate, it's still in a negative downtrend. You just look at what the businesses are doing and what the stock prices are doing. And if you look at infrastructure, same thing. Maybe we've had a low last week, but you don't know if it's a low until time goes by. But still, everything is relatively negative, defensive on our positions, taking our cash, and we're going to sit on our hands until we get some sort of reason to be more positive. Yeah. But I'd throw it back to you and saying there's all sorts of businesses that are doing great.
Yeah, no, actually, so one thing on that, like before that question or comment, the other thing that's interesting actually on your first idea thought was that let's say there's a lot of stocks today that are basically at the same level near the low that they were at in COVID. What's interesting about today is that like at the COVID low, there was a sort of a catastrophic global event. There was a monetary response where interest rates got cut to zero. You were clearly going to have a very sharp, shallow, or a very deep, but potentially condensed recession. But the cycle was then sort of abruptly brought to an end. But you could see the other side of the cycle starting into April, May, June 2020. Where what's changed today is that a lot of these stocks, whether you look at in the U.S. or look at things in Canada, things that are, let's say, at their COVID lows, but we're at a point where the cycle hasn't even played out yet. So if on real estate, for example, financing costs are high, a lot of these stocks are at new lows, but the real estate recession cycle is still, that wouldn't even be like accepted fact across different market participants. Like people are like, well, maybe it's going to be okay. Maybe we'll have a soft landing. Maybe they'll cut interest rates. So you're not even at an accepted.
I think even everybody's normal anchor, mental anchor to the housing prices. It looks like Toronto housing prices are weak, but that's in like the last 2 weeks.
Yeah, this is going to be a much longer cycle potentially to play out. So there's that aspect, which is an argument in favor of a more defensive positioning. Your other comment, which is things that we own that are doing fantastic or businesses that are completely fine, whether it's looking at like Circle K, Couche-Tard, gas stations throughout North America and convenience stores, Murphy's gas stations and convenience stores, like very simple, stable businesses that we have really good durability on. What we think their earnings will be through a recession. So they're not expensive. So the businesses are completely fine. Something like, some of the segments of our consumer, resilient businesses like an AutoZone comes to mind. Some of our other businesses that are much more focused on benefiting from ongoing fiscal spending on infrastructure, they seem to be doing fine. All these things they could all come off, but at least we have a durability and view on earnings out the next, 6 months, year, couple of years. Like even I did a BNN segment this morning, and the comment or the question was, how are you thinking about earnings, in light of its earnings season right now? And my comment was, what we try to do is not own a company where we have to worry about any individual quarter. If we have to worry about that short term of an event, it probably is a signal that we shouldn't own the stock, or we don't have enough confidence in that long-term earnings potential where we're worrying about it. That's kind of a barometer that's simple to use, but it's relevant to what we're trying to do. But like if you go through our portfolio and what we own, there's a lot of things that I'm sure will have earnings come off, but I think the underlying earnings power of our businesses is kind of unquestionable, at least from our judgment looking here today at them.
And also
it's exciting about it too.
But if you own a good business that makes money, it's so essential if and this is what we put in the quarterly letters, roughly our core of businesses, at least picking on the ones that we have, consumer industrial businesses in the U.S. that are trading at roughly 15 times earnings collectively, compared to the big technology stocks that are trading at 40.
Yeah.
So again, one of the ways I like to phrase it is, if your stock trades at 40 times earnings, it better be growing.
Yeah.
And they're not really growing, and the economy does stall. And there's other arguments you can make now that they're all now kind of trying to cannibalize each other's businesses. And we would say that this is fine. They can all do well. We're going to just avoid it, and we're going to go do our thing and find our high quality businesses and where they are not expensive.
Yeah, no, I think that the part of the equation isn't just about earnings and can a business grow its earnings, is that, well, what multiple are you paying for that? And when you have a business that has high expected earnings growth from their investors at a high multiple, if either of those two disappoint, you kind of have a double whammy in reverse, because your multiple can get compressed and your earnings expectations can be, far worse than expected. Where what we try to do is own things that are so outside of what you generally would see on financial news or in the newspaper, businesses that we know very well, but they're not sort of household names necessarily for most individual investors, but things that are able to repurchase shares that are not trading at expensive multiples. If you buy a company at 10 times earnings and they're buying back their stock after reinvesting in the business, it doesn't take you that long for you to be on side on your investment, because essentially what they're doing is shrinking their share count. Everyone who doesn't want to own the shares is selling to the company. And as a long-term shareholder, you essentially own more of the pie that is the sort of economics earnings potential of the business. So it's when you're buying back your stock at 10, 15 times earnings or lower, like some of ours are, there's a lot of downside protection. It doesn't mean the stocks can't go down, but the inherent vulnerability in that kind of business is really low. But if you own a technology stock at 30 or 40 times earnings with a high embedded earnings expectation, I know I'm using a lot of jargony words here, but there's a lot of downside. There's a lot of things that can go wrong, where with what we're doing, we're trying to do the complete opposite of that, saying our margin of safety is so high through most of our portfolio that regardless of what happens, we're very comfortable with our current sort of roster of investments.
I want to hit one last point then, because this one again comes up a lot, and it's the margin of safety question, but it's also with the Canadian dollar, which has been weak. I mean, our framework is just that it's not so much the Canadian dollar is weak as that the U.S. dollar is sort of globally strong. Mm-hmm. But just a comment quickly on just how we built, because I would say we've done this ahead of time. The Canadian dollar has been weak, but ahead of time, what is our U.S. exposure now versus what it has been?
Yeah, I think in the letter, I think we're roughly at 30%. Part of that is because some of the U.S. investments have gone up, whereas some of, and we've got the cash position as well. And I think we try not to, there are moments where we would force ourselves to be more looking at Canada if the Canadian dollar was really weak. And if the current Canadian dollar was really strong, we're almost forcing ourselves to look at the US just on a relative attractiveness. But we're kind of in a range where it hasn't been it's not an overt focus, because it's not like, I think as strong as the US dollar has been against, like, let's say the euro, it hasn't been that strong against the Canadian dollars. And part of this, is something that we've touched on in previous letters because of commodities and energy specifically that we're exporting. There has been this higher, demand for the Canadian dollar in the last year and a half, which has helped the currency. But we're roughly at a third, but maybe you have a different take, but I would say we're kind of agnostic on the currency here. Whereas we're just trying to find the best companies we can find at the right price. But the currency is neither too hot nor cold that it's sort of a large factor in an investment decision, either buying or selling. Would you say that's fair?
I would say in the middle of the range. Yeah. Where we have historically, just depending on what the stock market does, we've had very little foreign exposure. It's over a 20-year period. Yeah. I would say it's quarter neutral at 30%. But I also want to give that point that most Canadian businesses that we own have a big North American footprint. Yeah. And even something you mentioned, Couche-Tard, which is Circle K, it's 80% outside of Canada. And so it's really, we've built a portfolio that is getting cash from a North American footprint. The businesses are a North American footprint, and many of them are around the world. And so this is not a Canadian-focused portfolio from a cash point of view at all.
Yeah, no, I think that's very well said. Okay, so why don't we wrap it up with there? It's about 20 minutes, and we'll look forward to the next one. Hopefully we'll try to get out a sort of intra-quarter podcast again on maybe a couple specific topics that we find interesting or that we've been getting questions on as well. So hopefully we'll get one out again in the next few weeks as well.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.